If you've been watching the quantum computing space, you've probably noticed something unusual happening with Rigetti stock. The share price has taken a sharp hit over the past month, and today we're going to break down exactly why that happened, what's really going on inside the business, and whether this is an opportunity or just a value trap. Let's get right into it. So, first, the most obvious trigger: earnings. Expectations going into the quarter were pretty modest. Investors were looking for a little above $2 million in revenue. Rigetti came in below that, delivering under 1.9 million. And the problem isn't just one quarter. This miss lands right on top of a clear downtrend in the company's revenue. If you zoom out and look at Rigetti's trailing 12-month revenue all the way back to 2021, you see a peak around 13.1 million. Since then, a steady decline down toward roughly 7.5 million. That's not what investors expect when they hear high growth frontier technology. Typically, you want consistent acceleration. Rigetti's curve is moving the other way. Now, management has been transparent about this. They've said repeatedly that revenue will stay choppy for the foreseeable future. And honestly, the reason makes sense. Most of Rigetti's revenue today comes from governments, institutions, and research programs, not from commercial enterprise customers. These institutions are experimenting, testing, and exploring potential applications, but none of this is recurring, scalable demand. Until real commercial use cases emerge, the revenue stream is going to be unpredictable. Let's break this down even further. Quantum computing companies like Rigetti are essentially pre commercial businesses. Yes, they generate some revenue, but it's nowhere near what it would look like if enterprises were actively deploying quantum tools at scale. You're watching a company still deep in the R&D phase, trying to hit technological milestones before it can even think about real monetization. And when a business is in that stage, cash runway becomes extremely important. Rigetti currently holds about $26 million in cash, but here's the challenge: they're generating around $2 million in revenue per quarter while losing multiples of that. In other words, the burn rate far exceeds the revenue inflow. 26 million isn't a lot of oxygen at that pace. It gives them some time to make progress, time to hit a milestone that excites investors, but not a lot of room for error. This is why the company has repeatedly tapped shareholders for more capital. When the stock price spikes, management uses that window to raise money and extend the runway. It's a survival strategy common among early stage deep tech companies, but it also dilutes shareholders and raises questions about how long the company can keep doing this. And the financial pressure shows up clearly in the operating cash flow to sales ratio, which continues sliding deeper into negative territory. But again, this is what happens when almost every dollar goes into research and development. They are betting everything on breakthrough technology that could one day attract major commercial demand. Now, add one more factor that spooked investors recently: competition. Chinese researchers announced breakthroughs in quantum computing, and any sign of accelerating global competition tends to push US quantum stocks down. Rigetti got caught in that sentiment. When you're an early stage player fighting for relevance, global advancements, even from competitors, can move your stock dramatically. So, what does all of this mean for investors? Here's the truth: Rigetti is swinging for a home run, not a base hit, not a double, a full blown moonshot. If the company achieves technological leadership and cracks commercially valuable quantum applications, the reward could be massive. We're talking potential 10 times, 25 times, maybe even 100 times style outcomes over time. But the probability of that outcome is low. The risks are extremely high. The cash runway is limited. The technology is uncertain. The revenue isn't stable, and competition, both domestic and international, is heating up. So, is this stock a buy? For most investors, the answer is no. It's simply too speculative at this stage with too little evidence that commercial adoption is close. This is the kind of investment you only make if you're intentionally taking a high risk, high reward shot with a very small slice of your portfolio. Think of it like a lottery ticket style allocation, something you're comfortable losing entirely in exchange for the possibility of outsized upside. For me, it's not a buy, it's a hold. The company has potential, but not enough proof yet to justify a meaningful conviction. I can understand the appeal for risk seekers, but overall, the stock sits firmly in speculative territory, and that's the full breakdown. If you enjoy analytical deep dives like this, where we cut out the noise, focus on real numbers, and evaluate companies with a disciplined process, stick around for more clarity driven stock analysis. Let me know what company you want me to cover next.